All right, welcome. Today, we're diving into a real head-scratcher from the world of retail that I think you're going to find fascinating.
I mean, just think about that question for a second. We are talking about Costco. You know, the place with parking lots that are always packed and shoppers who are fiercely loyal. But somehow, the very thing that makes them so successful, their insane popularity, seemed to be what got them in trouble on the stock market. How does that even work?
And look, we're not talking about a small blip here. Costco's shares took a serious hit, falling about 20% from their highs. Now, for a retail giant that seems to be doing everything right, a drop like that makes a lot of people nervous and starts raising a ton of questions.
So that's exactly what we're going to do here. We're going to unpack this whole story, we'll look at their absolutely massive sales numbers, dig into the real fears that drove the stock down, and then explore this really cool counterargument that completely reframes the whole situation.
Okay, first things first. Before we get into all the investor anxiety and the Wall Street drama, you really have to understand just how incredibly well Costco is actually doing. And their recent holiday season pretty much says it all.
Let's just start with this giant number, almost $30 billion. That is how much Costco brought in December alone. For one single month, that figure is just incredible.
And that wasn't some fluke. That's a solid 9% increase over the same time last year. In today's economy, believe me, that kind of growth is a very, very positive sign.
But check this out. Their online performance is even more impressive. Digital sales shot up by nearly 19%. This is huge because it shows Costco is successfully growing way beyond just its physical stores, which is absolutely critical for the future.
So, you see, the success wasn't just from one thing. It was this perfect mix of their classic strength, just tons of people walking into their warehouses, plus really powerful international growth, and that online momentum we just saw. It paints a picture of a really, really healthy business. Okay, so if the sales numbers are that good, what on earth were investors so worried about? This brings us to the other side of the story, this weird crisis of confidence that led to that 20% pullback in the stock.
You know, the core fear wasn't really about what's happening today. It was all about the future. Wall Street started to get this idea that Costco's amazing growth engine might be starting to sputter, that maybe its best days were in the rearview mirror.
More specifically, analysts were pointing to a few things. They saw that the growth in new membership signups was slowing down. They saw that sales growth in existing stores was decelerating. And they were worried Costco just couldn't keep topping its own incredible performance. The crucial thing here is that perception was really starting to separate from reality.
But then, a new analysis came out that just flipped this entire negative story on its head. It suggests that these apparent weaknesses, well, they were actually symptoms of incredible strength.
And this is it. This one quote from Mizuho analyst David Bellinger is the key to the whole puzzle. He argues that the problems Wall Street is seeing aren't signs of weakness at all, but the direct result of Costco being too successful, of having what he calls an incredibly high-quality problem.
So how can having too much demand make your growth look slower? It sounds kind of crazy, right? Well, the answer is this concept of fill-in warehouses. These are new Costco stores they build in markets that already have a Costco. They're not for breaking into new territory, they're built to relieve the insane crowds at the existing super popular stores.
And this shows the disconnect perfectly. On one side, you have the problem, slowing growth, but the underlying strength is that over half of their new stores are just these fill-ins designed to ease the congestion. And while the total number of new members might look a little weak, the number of people upgrading to the more expensive executive membership is actually surging.
And when you really dig into the membership data, the story gets even better for Costco. Their domestic renewal rate is over 90%, which is fantastic, and it's actually above the 10-year average. This shows their most loyal, most valuable customers are more committed than ever.
And there's more good news on the financial side of things. After a period of higher spending on wages, those costs are starting to normalize. And that means more of that strong revenue is going to flow right down to the bottom line, which improves profitability.
So, with this new way of looking at it, the analyst is basically saying we should look at Costco's future not with fear, but with a sense of déjà vu and the potential for a lot more dollars for shareholders. Because get this has happened before. Back in mid-2017, the stock had an almost identical pullback for the exact same reasons. Investors were worried about those fill-in warehouses. And what happened next? Growth picked right back up, and the stock went on to massively outperform the market. It really seems like history is just repeating itself.
So based on all this analysis, the Mizuho firm took some pretty decisive action. They upgraded the stock to a buy, they added it to their exclusive top picks list, and they gave their price target a major boost.
And here is that target, $1,000 per share. That is a bold statement, and it shows a deep conviction that Wall Street's recent panic was just a huge misreading of the whole situation.
And as a final little bonus, the analysis flagged the high potential for another special dividend for shareholders in a couple of years. Another direct reward for the investors who stick with the company through all this perceived turbulence.
So the takeaway here is that what looked like a problem on the surface was actually a sign of overwhelming success. And it leaves us with a really fascinating question to think about. If having too many customers is a high-quality problem and a winning long-term strategy, what other popular companies out there might be showing similar misunderstood signs of strength?